Hi everyone, I'm Andy, and this is the AI Breakdown. Welcome to your weekly news edition, where I'll cover what happened in AI last week and why it matters. Let's start with Cerebras, because the public markets have finally had to answer a question people have been kicking around for the last year. What is a serious AI hardware challenger actually worth once real investors have to price it in broad daylight? Well, on the 14th of May, Cerebras started trading on Nasdaq under CBRS. It priced 30 million shares at $185, opened publicly at $350, and closed at just over $311. That left it up 68% on day one, sitting at a massive market cap of roughly $95 billion, which is a very loud way of saying, unsurprisingly, that the market is absolutely willing to take AI infrastructure seriously. And that matters beyond the usual IPO theatre. Cerebras is not NVIDIA, and that's the point. It has built its story around wafer-scale chips and around inference rather than training, which is a more practical commercial battleground for a lot of buyers. Cerebras says those wafer-scale engines pull what would normally be dozens of GPUs onto a single chip, and that's central to why it keeps pitching itself as a different kind of AI hardware company. The company posted 2025 revenue of $510 million, up about 76% year on year. And while they aren't fully profitable just yet, they drastically narrowed their losses after a brutal year before. Plus, there is that massive $20 billion supply deal with OpenAI sitting in the background, which dramatically strengthens this whole story. Now there is a catch. Right now, Cerebras has huge customer concentration. Nearly 86% of their 2025 revenue came from just two entities in the UAE. That makes the OpenAI pivot crucial. And the day after the IPO, the stock gave back about 10% as people remembered that paying over 170 times trailing revenue is, how shall I put this, ambitious. If the OpenAI ramp slips, or if the inference story disappoints, public markets won't be sentimental. But the really important bit is what this does to the category. This was the largest tech IPO since Snowflake in 2020, and the first pure-play AI hardware listing of the cycle. So suddenly, every private AI infrastructure company with a pitch that boils down to alternative to NVIDIA has a fresh reference point. Names like Grok, Samba Nova, Tenstorrent, Etched, MatX, Lightmatter, and Rain AI all now have a much higher public comp to point at. My read is that this is a proper line in the sand. Not because Cerebras is about to beat NVIDIA tomorrow, it's not. The real shift is that public markets have now given enterprise buyers permission to take second-source AI silicon seriously. Once a company like Cerebras is worth this much in full public view, a CTO doesn't sound reckless for asking for a non-NVIDIA option. The signal stands. Public investors have just told the market that frontier AI hardware beyond NVIDIA can attract enormous capital. And once that signal is out there, it changes how fast the rest of the field can fund, hire, and build. Let's stay with the funding story for a second, because there's a massive development with Anthropic since our last update. It's just been reported that Anthropic has agreed to terms on a fresh $30 billion raise at a staggering $900 billion valuation. No signed closing papers just yet, but the fact that terms are set tells you exactly where this market has moved. A few weeks ago, we were talking about Google and Amazon deepening their commitments. What's new now is that financial investors are lining up at a level that puts Anthropic right up there with, and on some measures above, OpenAI. Bloomberg says Dragoneer, GreenOaks, Sequoia, and Altimeter are co-leading the round, each anchoring it with at least $2 billion. If the deal closes at the top end, Anthropic would actually edge past OpenAI's last valuation, which clocked in at around $852 billion back in March. The backdrop here really matters. Anthropic's annualized revenue run rate skyrocketed to $30 billion this spring, up about 80 times year on year, and they now have more than 1,000 enterprise customers spending at least $1 million annually. That helps explain why the valuation sounds absurd, and then after a moment merely extreme. There's also an October IPO timeline being openly rumoured in the market, and that changes the tempo. Once an IPO window is even vaguely on the table, every product launch, every partner announcement, and every vertical push starts looking like S1 preparation. You can already see that happening. Take their massive push into the legal sector. Thomson Reuters just announced they've rebuilt their co-counsel legal platform from the ground up using the new Claude Agent SDK and Model Context Protocol. We are talking about putting Claude into the hands of over 1 million legal professionals across more than 100 countries. That doesn't look random to me. It looks like a company trying to show incredible enterprise depth and commercial traction all at once. What does this mean if you're actually buying AI rather than just watching the scoreboard? My view is that a dual vendor strategy is no longer the cautious option. It's the sensible default. For a while, some teams still treated Anthropic as the smaller alternative to OpenAI. That framing is officially out of date. If Anthropic is raising at this level and eyeing the public markets, your procurement, governance, and integration plans need to assume 2 top-tier vendors, not one leader and one backup. The bigger point is that this isn't just about Anthropic's cap table. It's a sign that enterprise AI is settling into a few very powerful ecosystems, and buyers need to plan for that reality right now. Keep that in mind, because our next story shows the exact same arms race logic turning up in infrastructure spending too. Now, one story that really captured the mood of the week came from Cisco. On the 13th of May, it reported record quarterly revenue of $15.8 billion, beat expectations, and said cumulative fiscal 2026 AI infrastructure orders from hyperscalers had already reached $5.3 billion. That's above its previous full-year target, and Q3 alone brought in $1.9 billion of those orders. Cisco also lifted its full-year AI orders target to roughly $9 billion, which makes this look less like a one-off quarter and more like a demand wave. So the AI build-out is very clearly flowing beyond chips and into networking, optics, and all the less glamorous kit that actually makes data centers work. Acacia, Cisco's coherent optics business, did more than $1 billion in orders in the quarter and is on track for more than 200% growth year on year. That tells you something useful. The bottleneck isn't just compute, it's bandwidth between racks, across campuses, and all the plumbing in between. NVIDIA gets the headlines. Cisco is selling the shovels, cables, and picks needed when everyone else starts digging. And then, within hours of that earnings beat, Cisco announced roughly 4,000 layoffs. That timing was grim, but it was also clarifying. Chuck Robbins framed it as a shift in investment and cost structure towards the areas with the strongest long-term value, which in practice meant more AI and cybersecurity spend. CNBC's write-up made the contrast painfully clear. Record revenue, huge AI orders, thousands of jobs cut. If you wanted one clean example of how AI capex and labor reduction are starting to show up in the same corporate sentence, this was it. I don't think Cisco is an outlier here. I think it's early. We've already seen versions of this pattern at Microsoft, Meta, and elsewhere. Companies are protecting margins, redirecting spend, and telling the market they're serious about AI. The uncomfortable bit is where that money comes from. Quite often, it comes from people. And this is becoming the new normal in big tech. And the truth is, the market is training executives to do it. When Cisco can post huge AI demand, cut 4,000 jobs, add $35 billion in market value, and still get rewarded, boards get the message, trim labor, buy more AI, call it discipline. This episode is sponsored by Notify Technology, a health and safety software partner, helping teams run incident management, audits and inspections, and risk assessments in one place. And with Notify Spark, their AI companion, they're streamlining incident reporting and investigations, saving time, reducing admin load, and helping teams act faster on what matters. Learn more at notifytechnology.com. A couple of mid-tier stories are worth your time as well. First, Notion has launched a proper developer platform, and I think this is more important than it might look at first glance. The headline feature is an external agent API that lets third-party agents from Claude Code, Cursor, Codex, and Decagon operate inside Notion workspaces as first-class participants. Add workers, database sync, and a command line tool. And Notion is no longer just trying to be a nicer documents and databases tool. It wants to be an agent hub. That puts it into much more direct competition with Microsoft, Slack, Atlassian, and anyone else trying to make the workspace the place where agents live. Notion says teams have already built more than 1 million custom agents since February's beta, which gives this push a bit more weight. For me, this is a smart move, because people generally want these systems where the work already is, not in yet another dashboard nobody checks after week 2. The question is whether Notion can add the governance and audit controls bigger customers will want before Microsoft leans on distribution and makes life awkward. And then there's Microsoft security. So that OpenAI Daybreak story from last week already told us cybersecurity is becoming a very serious proving ground for agentic systems. This week, Microsoft pushed that further with M-Dash, its multi-agent security harness, which beat Anthropic's Mythos on the CyberGym benchmark and helped find 16 new Windows vulnerabilities that are now patched. Microsoft says M-Dash scored 88.45% on CyberGym, roughly 5 points clear of the next system, which makes the result harder to wave away as marketing. The notable bit for me is architectural. M-Dash uses more than 100 specialized agents across a mix of frontier and smaller models. In other words, the winning pattern here isn't one giant model doing everything. It's a coordinated team of models doing different jobs well. I'd expect other vendors to follow that path quite quickly. In cybersecurity especially, single model purity is starting to look less important than whether the whole system gets the job done with a low false positive rate. Right, let's rattle through a few more before we wrap up. Anthropic also launched Claude for small business and started a 10-city US tour in Chicago with free workshops for local business leaders. I think that's shrewd. The connector set is the story here. QuickBooks, PayPal, HubSpot, Canva, DocuSign, Google Workspace, Microsoft 365, and Slack. Anthropic says it ships with 15 ready-to-run workflows and 15 reusable skills. So, that's Anthropic moving below the Fortune 500 and trying to become useful to the owner who already has 6 jobs and no spare time. Boomi, meanwhile, used Boomi World in Chicago to push much harder into the agentic enterprise. The interesting bits are Boomi Connect, its MCP registry, Orchestrate, and a distributed agent runtime that lets companies run agents on-prem behind their own firewalls. Add the Red Hat partnership, and you can see the pitch very clearly. If you're a bank, hospital, or heavily regulated buyer that doesn't want all this running in someone else's cloud, here's another way to do it. And Boomi is timing that pitch around Europe's data sovereignty push, with the company explicitly tying the stack to buyers preparing for the EU AI Act deadline in August 2026. And then there's Microsoft having a slightly awkward week from a narrative point of view. On one side, it's beaten Anthropic on a cybersecurity benchmark. On the other, Mustafa Suleyman's claim that AI could automate most professional tasks within 12 to 18 months got another round of coverage, while former Microsoft executive Matt Veloso said publicly that Microsoft has missed the AI wave like the internet and mobile. That sounds harsh, but the Copilot numbers keep haunting the company. About 15 million paid seats out of roughly 450 million Microsoft 365 seats. That's roughly 3.3%. It's not a collapse, but it's a long way from inevitability. That's all for this week's AI Roundup. If you found value in this breakdown, please leave a rating and hit subscribe. See you next week.